Hello, my name is Richard Krivo. I'm with Daily FX Education, and I'm here today to talk with you a bit about how I go about trading a range. And the first thing I want to do is identify a range. I want to scroll through the charts and see if, in fact, there is a viable range that's available to trade. And I would look at a daily chart, I'd look at a 4-hour chart, and I'd look at a 1-hour chart. And what I'm looking for essentially on the chart, let's say this is price action, it's been trading to the upside, higher highs and higher lows, moving in an uptrend, and then it reaches a point where it's not making any higher highs or higher lows, it's just trading in a horizontal fashion between a very defined level of support and a defined level of resistance. Now, once I see that type of a formation on a chart, and it makes no difference what the time frame on the chart is, I know I've got a range that I want to examine a little more closely. So let's take a look at this as being kind of a blown up, a little more detailed version of this up here. What I'm looking for, again, is this defined level of support, defined level of resistance, and price action moving between those two levels. Now, I want to confirm this range, and a couple ways I can do that. If I'm a more conservative trader, what I'm going to look for is at least 3 touches of price action along my support line, and I'm going to look for at least 3 touches of price action along my resistance line. 1 touch of support or 1 touch of resistance, obviously those are just dots on the chart. They're meaningless unless we have other points that we can line up with them. A more aggressive trader might look for only 2 touches of support and 2 touches of resistance. So once I've identified the range and I've made my confirmation of the range, then it becomes a pretty simple matter of just going long at support when the pair has touched down to the support level, when price action is down there, and going short when the pair reaches a resistance level. So I would go long at support, buy the pair at that point. I would place my stop below the lowest price, which price action has penetrated my support level. And in this case, this would be the lowest point right here. So I place my stop down there, and then I'd let the pair trade up to the resistance level. Once it got up to the resistance level, I would close out my profitable long position at that point, and then wait, in fact, for the pair to make a move to the downside, and I would enter the trade short at that point. Now, in this case, we can see price action traded up through the resistance level a little bit. So in this case, I'm going to have to place my stop here so that it takes into consideration this particular wick up right there. So I'd have to place my stop right about in that area right there, and then let the pair trade down to the support level, and then continue to do that same process for as long as the range remains intact. Now, one thing I want to mention to you is don't get into trades in the middle of a range. If you take a look at a chart and you go, oh man, I missed the trade, it's already in the middle of the range. Don't jump into it in the middle. You're taking on more risk. The movements of a currency pair in the middle of the range, kind of you can refer to it almost as a no man's land, are going to be much more random. Wait until it trades down to support. Wait until it trades up to resistance so you can get your higher probability entries. And if you can't wait and it's in the middle, try working on developing patience and discipline, because that's going to be a key part as to whether or not you succeed in trading. Whether you're trading range or whether you're trading trend or any other type of trading, patience and discipline are things that you want to develop. Now, as far as money management goes in range trading, what I'll do here is I'll wait until the pair trades up, especially if it's a longer range, like on a daily or a 4-hour chart. I'll wait until the pair trades up about to the halfway point of the range. And then I can do a couple things. I can close out a portion of my positions if I was trading multiple lots at that halfway point and move my stop to break even. What I'm doing by doing that is I'm locking in profit by taking those profitable lots off the table, a portion of them. Moving the stop to break even, I remove all the risk from the trade at that point. Or if I choose, I can choose not to close out any of the lots and just move my stops to break even. Moving the stops to break even, once you feel a level of confidence that the trade has moved up a good distance, that takes all the risk off the table. Because the worst thing that can happen to me with a break even stop is if that stop out occurs at that break even level, I have no gains, but I have no losses either, and that's not a bad thing. So I would consider doing that once a pair reaches the center of the range. And if, for example, we're on, let's say, a daily chart, and halfway up the range is 250, 300 pips, that's not bad. I'd take some profit at that point, and then I'd move the stops to secure the fact that I did not have any losses if the rest of those lots that I left open would retrace on me. The other thing that I employ when I'm trading a range is a couple of indicators that I'll use, oscillators in this case, either slow stochastics or the RSI. And what these do is they help me fine-tune my entries so I can go long or I can go short at the optimum point that I want to, and thereby removing a little more risk from the trade. Now, slow stochastics, which I've kind of drawn up here, I think you can use your imagination a bit there. Slow stochastics trades between its own range, if you will, between the 80 level and the 20 level. The strongest buying signal that slow stochastics can give is when the two moving averages have been below 20, they've crossed over each other, and then they close above the 20 level. Now, if I see that happening, and on my chart, let's say I'm right at this point, right here, I know that bullish momentum, upside momentum, is now favored because of what slow stochastics is telling me. So I could get long at this point with my stop in the same place, knowing that bullish momentum is in place, and that'll kind of give me a little extra push, if you will, to the upside. Does this in any way guarantee the success of the trade? Absolutely not. But it just peels away kind of another layer of risk. It helps me fine-tune, as I mentioned, the entry into the trade in the direction that I want to go. Now, slow stochastics gives its strongest signal to sell the pair when the two moving averages have been above 80 and then they close below 80. So if I'm at the top of the range here and slow stochastics is just getting ready to close below 80, or it has closed below 80, I know that now I'm in a higher probability area to short that particular pair because now bearish momentum is favored. The RSI works in a similar way, relative strength index, except the extremities are 30 and 70, and when the RSI has been below 30 and then closes above 30, that signals bullish momentum is in favor. So once again, if let's say I'm at this point on my chart and I see RSI has closed above 30, that indicates bullish momentum is favored on the trade at that point, and that would be a good opportunity to enter the trade. And then shorting the pair would be, again, if RSI is above 70, closes below 70, and I'm at that point on a chart, that could be an indication to short the pair at that point, showing that bearish momentum is now in place and would favor a short position. That's how I go about trading a range, and I'm glad you were able to attend this particular session. Thanks for attending, and good luck with your trading.